Dearly beloved, we are gathered here today to mourn the gains in Brother Curtis's portfolio. He was a good man. He was a working man. 16 months of hard work reduced to ashes. Ashes. Oh, listen. Let's start with the positives. I'm going to make one sentence right now. And if you only take away one thing from today's portfolio update, it's this next sentence that I say right here. If you believe in the business that you are invested in, if you believe in them long term, this is single-handedly one of the best gifts to investors. I sound like Bill Clinton. I did not have sexual relations with that woman. Listen, no, this is one of the biggest gifts to investors at the moment. This is an opportunity to get into your stocks that you genuinely believe in over the long term. Not hype stocks, not momentum stocks, just stocks that you believe in the business and you believe they're going to do well in the long term. And I genuinely can say that for 95% of my stocks, barring one or two, which we'll discuss later on today, I genuinely feel that's the case for them. This definitely is an opportunity. At the moment, it's an opportunity that I can't take advantage of because you guys know that I've maxed out my ISA allowance, so I can't invest. There was some people talking in my DMs this week about why don't you add money to your basic and then transfer it over. Listen, one, I haven't got time for all of that. Two, I haven't got no money for all of that. And three, I'm going to just start to save cash for the moment, build it up, monitor this coronavirus situation, and then start to deploy and put money into the market as I currently see fit, because I put the last £1,000 in quite hastily last time, and that was still at partly some of the peaks. And if I put that in now, at least I would be benefiting a little bit more from that. But anyway, in today's portfolio update, we're going to talk about this week in the market. I'm going to talk about oil and other sectors, my stocks, and my feelings towards some of my stocks as well. I'm going to give some information on previous epidemics, pandemics, and the bounce back. And I'm going to end with what I think investors should do. So if you want to know more, like, comment, subscribe, help the channel get to 5k subscribers. We can get the world of investing out to more people. Follow on Instagram at Infinite Investors. Listen, I haven't done that many videos this week, but hopefully you guys can forgive me because I've been talking to about 100 of you in the Instagram DMs this week, and we've been talking on a one-to-one basis about all manner of things within the stock market. So I've always been reachable, but this week has been a very busy week for me work-wise, so I haven't been able to do that many videos. But we've obviously got this portfolio update. I might do a live stream soon, maybe tomorrow, maybe in the next couple of days, I don't know, but I will let you know. And then obviously we can talk more publicly about anything that is on your mind. Also, my link is in the description, freetrade.io/infant-investors. Sometimes I get asked, what platform are you using? I'm using Freetrade. It says it in the thumbnail, and the link is in the description and the pinned comment. So if you click on that link and you sign up, we both will get a free share worth up to £200. You just got to deposit £1, and a free trade will basically give that to you. So this week has been crazy. Obviously, coronavirus, we've seen some of the worst day drops since the last recession, since the dot-com crash as well, which is crazy to think of. We've seen the oil price war situation triggered by Saudi Arabia because Russia didn't sign part of their agreement. So they've basically been flooding the market with oil, which has effectively reduced the value of oil and the price of oil. So people are seeing, great buying opportunities in crude oil and the like as well. We're seeing European flight bans to USA. So there's 26 countries, I think they're calling it the Schengen region, but it includes, Western European countries as well as Eastern European countries. They're being banned in terms of flights to the USA because of President Trump's perception of the way they've handled the whole coronavirus situation. I just watched a press conference with President Trump and how they're reacting to the coronavirus in the USA, and he actually mentioned on multiple occasions that the UK might be added to that list. It might be added to the list because the numbers of coronavirus cases in the UK has started to soar up. We've seen celebrities like football celebrities like Mikel Arteta and Callum Hudson-Odoi and loads of people that have been contracted. We've seen Tom Hanks, obviously he's not UK, but still we've seen loads of celebrities, loads of people that are being contracted with coronavirus. We're seeing the NBA is ban the league. They've just ended the rest of the league. Obviously, that's going to affect so much people in terms of jobs, not just obviously entertainment and people not being able to watch basketball, but people, that's their job. Some people might be, security guards at a stadium or something, or some people might be cleaners or janitors. It's always the regular, everyday, hardworking man that in these types of situations actually start to pay the price for it. So that's going to be a significant impact. You've got, the Premier League right now probably debating heavily to probably cancel this Premier League. Liverpool just can't catch a break. They will not win this season if they cancel the Premier League. They might just write off 2019-2020 as a league. To be honest, they should have written off 2019-2020 as a FIFA game, because that was just poor. But listen, the Premier League might be canned. So listen, a whole manner of stuff is happening, and I think it's just going to continue for a very, very long time. Previously, I evaluated this as very similar to the SARS epidemic. We've now surpassed the SARS numbers by quite a margin in terms of obviously people that have contracted it, and obviously in terms of people that have passed away from it as well. So it's bigger than that. It's bigger than that. People are comparing it to swine flu and a few other epidemics. So I'm going to look at that later on in this video. But literally, the situation is bad. The whole market is bad. The situation is bad across the board. From treasury bonds, which is considered meant to be a safe place, that's going down. Bonds are going down. You got pretty much every single stock is going down, bar maybe some healthcare stocks or some random ones that might be okay, that have managed to sort of fight through it. But generally speaking, I remember reading a stat that I think 490 of the S&P 500 stocks have been down this week. There's 500 stocks, 490 have been down. So listen, we are all in the same boat. Some people might have had a good performance on the one odd random stock here or there, but generally speaking, we're all in the same boat, and that provides a level of comfort for me. The saying, misery loves company. And listen, it is actually kind of real in this case, because this, as I've mentioned, is not a symbol of your stock picking decisions. This is a macroeconomic market factor that, to be honest, we would never be able to control this, and you will never be able to control the panic of this and what's happening. The market is in panic mode at the moment. So there's obviously going to be big sell-offs. There are times when you think, oh, maybe it's going up a little bit. You can see this little period here where it's like, oh, maybe it's going up. No, the same thing kind of happened here. The same thing kind of happened here. It's not going up. Typically, this is just the simple case that when everything has been selling off too much, you got some people thinking that I'm going to start buying on the way down. They've started to buy. It starts to curve up a little bit, and then obviously the pressure carries on again, and it continues to go down. So listen, it's dire out there. It's very, very dire out there. But if you are a new investor, I do think this is probably one of the best lessons, one of the best times to actually be in the market. And obviously, if your job is safe and you've got an income, which is your biggest wealth generating tool at your disposal, then you can start to save and you can start to put money away, and obviously it's going to help you in the long run. Let's look at this week in the market. We're seeing at the FTSE 100. I'm going to put the FTSE 100 on the screen for this. Let's find one of their ETFs. Vanguard. Don't do Vanguard that much, so let's put Vanguard. So we can see that, you can see on this Vanguard it's gone down 27.46, but what I wanted to talk about is basically what's the situation with the FTSE 100 this week. So what we're seeing is that, listen, I'm taking this from The Guardian. The financial world is reeling after the most dramatic week since the financial crisis. Imagine that. Investors are counting their losses while economists fear the world economy risks a painful recession this year. Anxiety that the global policymakers are failing to tackle the COVID-19 pandemic wiped trillions of dollars off the stock market across the globe. The turmoil was compounded by Saudi Arabia launching an oil price war, which threatens to put some US shale producers out of business, triggering debt defaults. For younger traders in the city, this was their first introduction to the true panic on the trading floors. And forget the traders in the city, I'm talking about everyday guys like me and you. This is a really good. Listen, I thought the trade war situation last year was bad. I thought PPI was bad last year. I thought the recession and the Brexit situation last year was bad. We've gone through quite a few macroeconomic situations. I thought they were all bad, but there's obviously nothing like this coronavirus situation. This has definitely been, the big hitter. And obviously there's a lot to learn from this situation. So definitely take this in. The FTSE 100 has already been through 2 bad weeks, but the last 5 days inflicted the deepest losses yet on the nation's pension pots, ISAs, share portfolios and funds. By Friday's close, it had lost 1,096 points or 17%, shedding £275 billion in a week. It lost nearly 20%, nearly 1/5 of its value in a week. In a week. If that repeated in 5 weeks, businesses are going bankrupt. Like, I think sometimes we hear these numbers, we hear 20%, 17%, but we don't actually put it into real terms. If that happened for the next 5 weeks, businesses will go bankrupt. That's literally the case for it. And the government would have to do a bailout of, the businesses that they wouldn't allow to go bankrupt, and would be literally in similar recession territory without the whole, 2 months GDP situation. So obviously it's a very, very significant thing. In terms of crude oil, have we got any oil stocks in here? I'm sure we do. We must do. Let me put crude oil. It's been a crude situation. Oh, there's no crude oil. All right, cool. I'm going to put on the screen Shell. Don't know why. It just stuck out to me, maybe because it's yellow. But listen, even older city heads hadn't seen anything like it. Oil suffered its biggest crash since the 1991 Gulf War after Saudi Arabia dramatically. I mean, that's what 29 years ago? It's crazy. After Saudi Arabia dramatically vowed to flood the market with supplies, Saudi ordered its producers to turn the taps up after Russia refused to back an OPEC plan to curb output. This shocked the markets as COVID-19 is already cutting energy demand. Brent crude plunged by a third to $31 a barrel, while US crude hit $27. Shares in oil producers across the globe fell too, helping to trigger Monday's market crash. Obviously, it's been absolutely significant for oil as well. But some people are seeing it as an opportunity. Oil is not something that I genuinely invest in, so it's not really something that I personally I don't want to say I don't care about it, because I think that's the wrong terminology, but it's not my focal point, I would say, when I'm thinking about my investment decisions as well. America's bull market celebrated its 11th birthday this week and promptly stomped off. Both the S&P 500 and the Dow Jones indices of US stocks plunged over 20% from their record peaks, putting them into a bear market. You can see on the screen now the S&P 500, and obviously what's basically happened with that. The end came amid wild swings, usually downwards on Wall Street, as Donald Trump's shock ban on EU travel to the US spooked investors. But there was a late rally too. Trump declared a national emergency to help fight the coronavirus threat. So you can probably see towards the end there was a little bit of a rally, but ultimately it's some people are saying it's a bit too little too late. But anyway, I wouldn't read too much into whatever rally you kind of see, because I think that obviously next week when the markets open, it can just continue to sort of hemorrhage money, and I think that's a very likely situation. The bull market began in 2009 as the world economy began to recover from the economic shock of the last crisis. The speed of its demise shows the next crisis has arrived. So they're calling this the next crisis. It talks about the volatility index. It's basically an index called VIX, the volatility index, and I'm going to really simplify this. If the volatility index is going up, it shows you that we're probably going to go down in the stock market a lot more, because there's a lot more volatility and there's a lot more losses that's probably going to be made. There's a bit more to it, but I'm going to just basically simplify it in that way. And then obviously bonds, US treasuries as well, are not really seeming to be a great place to put your money. So what does that look like in terms of my portfolio? What I'm going to do, I'm going to go through each and every stock like I did a few portfolio updates and just give you my thoughts and feelings on that. So I'm going to start with the ones that have obviously reduced the least and give you my thoughts and feelings. So the S&P 500 this week has gone down 4.59%. This is a stock for me that I'm going to continue holding long term. However, the thing I want to talk about relating to not really the S&P 500, but what the S&P 500 is, which is an ETF, is that I think ETFs is probably one of the best places, or maybe one of the best places to reduce your exposure. Individual stocks are going to be hit very, very significantly. So if you're one of those people, which I'm not one of those people, but some of you guys are one of those people that have an ETF portfolio, or mainly an ETF portfolio, I assume your losses are probably going to be a lot less severe than, say, the losses that I'm currently experiencing at the moment. And actually that might be quite a good thing. Being diversified in situations like this might actually be much more of a good thing than obviously going into individual stocks, particularly individual tech stocks with high level of volatility, even on the greatest of days anyway. But the S&P 500 has had the lowest loss for me, but obviously I do potentially think it will continue to drop. Virgin Money, 4.68%. That's the second less loss. I'm going to go down in order, and then at the end will be the ones with the worst loss for me. Nothing really to report on Virgin Money. They did announce a digital challenger bank, I think, in Australia, but other than that, really and truly nothing to report there. This is just a symptom of the market as well, but I'm pretty surprised that obviously the loss wasn't as big as potentially some other stocks, and some other stocks it could be. The SCMB JP Morgan Emerging Market Bond for me is I think it's a definite buying opportunity for me to get more shares in that. This is my monthly paying dividend stock, so obviously the more shares that I can have in this is obviously the bigger monthly return I can get from a dividend standpoint. And when I go to Simply Wall Street, my dividend returns at the moment is 1.94%, but my capital gain returns is minus 14.58%. The return you're seeing in the thumbnail is obviously the total return, which also includes the currency fluctuation between the US stocks that I hold and obviously my UK currency, which I used to basically buy that. And so dividends is definitely, we talked about this in many videos, but obviously for anyone that's new, I think dividend investing is probably one of the single sources of ways to defeat these negative situations, because you will obviously be making a continuous return, and by reinvesting those dividends, reinvesting those payments back into the market, then obviously over the long term you'll be compounding at a greater rate. So me and my bond is going absolutely nowhere. Then Shopify. Now Shopify is one of the 3 stocks that I've got which is still in the green. So amazingly, I have 3 stocks in the green. Shopify went down 6.55%. For me, this is now opening Shopify as a buying opportunity for me, because I really do believe in Shopify as a business. I'm still in the green for it. I only bought 1 round back in October, as you can see there, and Shopify was about 50% return before obviously all of this started to happen. Now it's sitting at about a 24% return, so it's dropped about 25% for me, but fortunately I'm still in the green. I was talking to somebody in the DMs about Shopify specifically, and the conversation came up, would I sell this, take the 245 profit off the table? It was probably about 300 at the time we had that conversation, and then put it into a stock that's down at the moment, and then obviously when everything recovers, buy Shopify again. And no, I won't do that. I don't really want to sell. I feel that's kind of trading, and I feel that's kind of a panic strategy, and it's not something that I'm really eager to do. I really just want to hold my stocks that I believe in. Shopify is definitely a stock that I've believed in. You guys have known I've mentioned this on multiple occasions, and I'll hold it, and then when the opportunity presents itself to buy more, like now, I will be buying more. Obviously I can't do it at the moment just because I can't put any more money into my ISA, but come the April the 6th, I will evaluate all of my stocks at that time, and with whatever money I have left over, I will decide which money I will invest into which stocks, which businesses, and obviously continue as per. Lloyds, we talked about Lloyds in previous videos, and I think one of the analysts talked about Lloyds potentially hitting the 40p mark. Lloyds is now at the 38 pence mark. Remember the days when Lloyds was at 61p? Right around here, 64 even, 64, and it is now shot down to 38 pence per share. What does that mean for me? It means I'm going to continue buying Lloyds. Obviously, I'm losing 32% at the moment, £556. My average price per share is 55 pence per share, which is obviously very high considering the current levels. So now I'm just going to be buying crazy like Lloyds when I get the opportunity to do so and get that average share price down. Obviously it will be going to quarterly dividends. I'll be increasing the amount of shares I've got, which is 3,000 shares at the moment, and I'm going to definitely be heavily investing into Lloyds once I've got the opportunity to do so. So yeah, I'm not going to prematurely jump into it now. I reckon that April the 6th will come along and most of these stocks will be in the same position, if not worse anyway, so I'm not rushing and I'm not panicking at the moment as well. Landsec, if we move over to the basic side, Only Landsec and actually British Land are probably two stocks that I have considered just potentially selling, and using that money to join on with whatever money I have at April the 6th to invest back into my main portfolio. So the way I basically see it is that even though I'll be selling at a loss, if I can sell these two at a loss, obviously, but use that money to go into one of the growth stocks or one into the other dividend stocks within my ISA, coupled with some other money. Anyway, that's what I'm currently thinking about with both Landsec and British Land. We can see that Landsec at the moment went down 8.25%. I'm just going to cover British Land now, even though I'll come to it later on in the video. 11.61%. So that has been on my mind, but at the moment I'm just not trying to act. I think the whole vibe that I'm in at the moment is just to sit and to observe and to take notes and just to watch and just to learn and just to observe. I'm not really trying to jump in and make any crazy or hasty decisions, like the Fed rate cut. Incidentally, I'm just trying to observe and just strategize what I think is best to do. And at the moment, I'm seeing this as an opportunity just to kick back, just to watch it all unfold and basically wait and learn from the situation, which is the way I'm basically taking it. Imperial Brands down 29%, £685 at the moment. Obviously, Imperial Brands is a stock that I'm just going to need to dollar cost average and put more money into. It is a quarterly dividend. It's incidentally my highest dividend paying stock. It pays me currently a dividend yield of, get this, when have we ever said a dividend yield is this much on this channel? Maybe in other channels you might have heard it. I've never said it though. The dividend yield for Imperial Brands at the moment is 15%, which is crazy. I have never ever said a dividend yield is 15%. On this channel, I don't believe. And so, it's just obviously testament to the fact that everything has gone down, and it's typically always inverted. So if share prices is dropping down, then the dividend yield goes higher. Share prices are rising, the dividend yield is lower, as it's just basically an inverse of that. But yeah, 15% dividend yield. So obviously there's an opportunity for me to potentially put more money into there, and get obviously a better return. So that with Lloyd's, I know for a fact I'm going to have some real serious conversations with myself in terms of how I'm going to manage the allocation between the two. The next stock, Legal & General, 11.47% down. I love Legal & General as a business, so for me it's just a continued strong buy. Obviously I am making a loss at the moment of 27%, £500, £573, but I'm not worried about Legal & General. Long term, I'm very, very happy with the business. This is obviously a market condition, and I'm just going to ride this one through. Then we can scroll down to Uber. 43% down in a month, 28.63% down in the last 7 days. And we can see that, listen, Uber is a transportation business, and we're seeing transportation companies taking a big hit. Now typically transportation companies, we are talking about cruise liners, we are talking about airlines, maybe railway companies, but technically Uber is a transportation business, and obviously any type of business that there's a very big shared economy or shared component. So you've got the fact that so many different people are going to be going into Ubers, and obviously someone might have coronavirus, the next person might be fine, now they've come into contact the driver, etc., etc. People probably are actually going to want to stay at home, want to reduce their Uber consumption. Potentially they're going to want to have their own vehicle or use their own vehicle, etc., just to be safe, etc. All people are going to react differently to the situation. So I do see Uber obviously taking a potential hit during this period. But again, when we look at the graph for Uber, which is really sad to see, Uber now is at its worst level it's ever been in its whole stock market history. But guys, I do believe in Uber long term. I do believe in Uber long term. I believed in Uber long term when I started investing into it, and obviously I've done quite a few rounds, as you can see, into Uber where I've thought there was dips and potential opportunities. So why am I going to stop now? And I'm going to continue investing into Uber, and this might be a great opportunity for me. So that's what I see. The next one was British Land, which you kind of covered, and then the next one is Aviva. Had a lot of interesting discussions in the DMs about Aviva. Aviva for me is down £712, 30% at the moment. It was always one of my biggest holdings for a while. When I compare it to Legal & General, I personally preferred Legal & General than Aviva, but some other people have talked about, Aviva's pensions are better than Legal & General, but I think that's one metric to look at. I think there's other metrics that I potentially was looking at in terms of how Legal & General diversified their business, and I've, preferred Legal & General, and I've seen their performance, and I've been monitoring it, and I've always felt that although sometimes they have a similar performance, Legal & General generally seems to be better. at this current juncture, I will not be selling Aviva anyway. I'll just be continuing to dollar cost averages down. It's a great dividend payer for me at the moment, and the dividend yield for Aviva at the moment is 11.4%. So yeah, I'm just going to continue to invest into this, recoup some of those dividends. I think actually the next dividend is not. The next dividend is actually fairly soon. It's fairly soon. Let me see if I can actually find when the next dividend. Anyway, whilst I look for when potentially the next dividend is for Aviva, me personally, I'm going to continue investing into this business because, you know, I think, well, first of all, no way on this planet am I going to be just losing £700 and selling. But two, I think a lot of these things will recover, and when they start to recover, then you know, people will start to see the benefits if they did invest at this time. The next time Aviva goes ex-div, which will be April the 23rd, so we've got plenty of time to potentially invest into Aviva before the next ex-dividend date, and then obviously that payment date will be in the summer around June the 2nd. That's the estimated time for Aviva. Now, the next stock, which again is is the second of the three stocks that's still in the green for me, is PayPal. PayPal went down 12.56%. But it's still in the green, clawing its way in the green, 4.59%. PayPal is probably the best business that I have in terms of balance sheet, no debt, absolutely great cash flows, great revenues, great earnings, and obviously no debt. So it's quite a safe business, I consider. And again, this is just testament to the market times at the moment. Now, you know what, I would kind of hope that things like PayPal would actually start to do not well in this time, but, you know, start to hold fire in this time, just because, you know, you have a lot more people potentially being at home, maybe doing online orders, not going out into supermarkets and so forth, potentially paying for goods and services via PayPal. I don't know, things like that probably is not irrational, I guess, to consider those as an opportunity. So I can expect maybe not in quarter one's earnings, but quarter two's earnings for PayPal, potentially that PayPal might be one of the stocks that say, actually, we had a great quarter two because of the amount of revenues and the amount of people that were actually using PayPal as a payment method rather than going out and shopping and so forth. So, you know, we'll see what happens there. Obviously, if you're buying things on Amazon, you can't actually use PayPal. Amazon, I reckon their earnings will be very, very good over the next, you know, couple of quarters, to be fair, just because, you know, I'm hearing people are just selling things like toilet roll for like 90 quid and stuff like that. So yeah, in Australia and all this mad stuff. So listen, some of these e-businesses that literally have a large market share, that people will potentially rely on during times like this, may in the next couple of months have a really good performance. So, you know, I wouldn't be looking at this down period as anything other than a potential opportunity. Then we go to, I can't even call it micro hard at the moment because it's just soft right now. Microsoft, 13.93% down, but again, for me personally, it's still a buy, and it's still something that I'm going to continue investing in over the long term anyway. Funnily enough, a lot of people that I know, their work is issuing, you know, the whole sorry, let me just get that sentence out again. Their work is basically issuing notices to encourage people to work from home, and so effectively they're going to be using collaboration tools such as Slack, which, if you don't know what Slack is a workplace collaboration tool. So tools such as Slack, and also Microsoft Teams, which is the reason what triggered me to basically talk about that. Now, obviously, most of these stocks are going to be going down anyway. However, what you might find is that a lot of businesses that don't really encourage remote working might start to take some of these platforms, which obviously they potentially pay for enterprise licenses with all of the plugins and so forth. And if they take some of these platforms, then actually you might see the revenue of Slack or Microsoft go up again in the second quarter of this year. So if that's the case, then actually there might be some opportunities. The way I like to think of this is just, I try to just look at it like a customer journey and just think logically, okay, in this situation, what are the most likely behaviors that individuals, corporations, governments, small businesses, etc., are going to take during this current time? And I think if a lot of businesses are going to encourage remote working where possible, where they don't have a sort of face-to-face interaction with their clients, then obviously potentially they're going to start buying some of this stuff off the shelf, using it, you know, paying for some of the licenses and so forth, and actually you might see the revenues start to increase for some of these businesses. But yeah, we talked about Microsoft. I think Slack is potentially something to watch out for as well, in this situation. But Microsoft have a product called Microsoft Teams, which effectively is a Microsoft knockoff of Slack. Then the next thing we've got is, I'm going to call it Granny Smith apple, because it's definitely not pineapple right now. It's not tasting that sweet at the moment. But at the moment, I think, again, it's a definite long-term play for me. And obviously it's providing, opportunities at levels otherwise not available. And if you look at, the last year's graph for Apple, you're still, if you invest in Apple at the beginning of the year and you just held, you're still 52% up. You're still 52% up. This is just a minor blip in the story. So actually, when you think about it long term, there is potential and opportunity. Some people, we talked about Microsoft lot. We talk about Microsoft every week, to be fair, but we talked about when is a good level to buy. And in the DMs, I was talking to someone, I can't remember who, about how do I work out what my price target is and what my when am I going to actually buy. And I just think you've got to take it on a case by case basis. Listen, I think investing is an art more than a science. Granted, there are some scientific, technical, mathematical elements to areas of the stock market, but ultimately, as I always say, when you look at a graph, you're looking at a representation of people's feelings towards a business, and people's feelings change with the wind, man. So obviously, if fundamentals aren't going to be considered by a lot of people, if people are going to go by news headlines, then this graph is just going to be a representation of that. And so sometimes you have to use a little bit of gut feeling and a little bit of instinct to kind of decide at what point am I going to invest, etc., etc. But for me personally, I'll just sit Apple out. I've done quite a lot of investing into Apple. It's only 6% down for me. I think I would like to see it much further down. You saw that I've got other stocks at 30% down, so I think I'll definitely try and target some of those ones more than Apple at this current stage. So I'll just probably hold Apple and just see how it goes from that standpoint onwards. The next one is First Solar. First Solar, I've mentioned to you, this is an energy stock that I definitely have wanted to kind of offload, but it's just not been doing well for a long period of time, to be honest. 34% down over the last year, as you can basically see, and this is something that I would like to replace with one of the stocks on my watch list, and that stock is the T word, Tesla. I think Tesla's a better energy stock when you look at all of their businesses, not just obviously their car business and electrical vehicle business, but you're looking at the solar panel business. And obviously I bought First Solar because of the solar panel business, and I looked at the fundamentals and it looked good, and then for the first month I bought it, it went up like 40%, like it was phenomenal, and I thought, I've just hit a gold mine. I did not hit a gold mine. I don't think I even hit a mine. I think I hit a land mine, because it just blew up. That's the mine I hit. It went a gold mine, I'll tell you that. So obviously I've learned from that. And maybe Tesla could become a buying opportunity. But if you're going to ask me now, Curtis, I can tell there's going to be a comment, Curtis, when are you going to buy Tesla? Not now. It's not low enough. It's just not low enough, and I think it's got a lot more to go. When I look at the year chart, I reckon it could probably go down to about the 350 mark with this whole situation before it's amazing rally. And so yeah, I'm just gonna wait. I'm going to wait for a time period and and just going to be patient with this. But I definitely think I would like to replace First Solar with Tesla. I think that for me feels like the more wiser thing to potentially do, because I've looked at First Solar's fundamentals, I've been looking at their outlook, I've been looking at their earnings, and I just feel like where I thought they were good at one stage, things have changed, and I don't think potentially they can sustain a profitable outlook over the next short term. Okta, which was one of the stocks that did well over the last couple of weeks, has started to tank a little bit now, 15.79%. But again, similarly for me, this is only down 4.34%. I've only done one round of investing into it, and so for me personally, I'll rather wait till it goes down quite a bit more. I can live with a 4.34% fall in a stock. That's minor. So where I've got stocks at 30%, this stock I'm just going to hold and take it from there. And then the third of the stocks that's still in the green, we've got AMD, 15.42% in the green, went down 19.72% this week. And yeah, for me personally, I've done 3 rounds of investing into AMD. Again, it's in the green, so it's definitely not a stock that I need to target heavily, although it's gone down 19.72%. And obviously a lot of analysts have raised their expectations. Some analysts came out this week saying they think AMD can get to $52 a share. I think last week we spoke about some analysts saying it's going to get to $60 a share, $62, $65 a share. There's obviously opportunity to buy at these levels, and I definitely believe in AMD over the long term, particularly with things like their deals, their the stuff that they're doing with their CPU business from Microsoft, and I think Sony and PS5 and all the other stuff. So yeah, maybe I will buy more at these levels, but I don't think this is going to be the first thing that I'm going to target, just considering all of the stuff that we've basically mentioned. Now, some of the three biggest fallers within my portfolio this week. I will start with Taylor Wimps has gone down 20.20%. I need cried. It's like 34%. I was like, no, I couldn't have been. 34% in the last month, 20% in the last week. Don't worry, I still believe in Taylor Wimpey. Overall, it's actually only down 12% for me overall, so it's technically not that bad. It's gone down 20%, but obviously I bought at really good levels. I mean, look at how long I've been investing and continually buying Taylor Wimpey. So really and truly, I'm not going to stop now. I believe in the business. I believe in the fundamentals. We talked about it on many occasions. The next one is Barrett. We see the house builders tend to follow a similar pattern. Barrett was my favorite stock of 2019. I mentioned that. Down 21.71% this week, but I'm only down 17.99%. And again, similar situation with Barrett. I will keep on buying. Down 38% over the last the year now is actually, that is a horrible picture. I posted something on my Instagram about the S&P 500 and how much it's fallen, and literally the picture looked exactly the same. This kind of steady volatile rise up, and then literally S&P 500, I think it said something like in that Instagram image, I think it said something like how it's lost like, I don't know, 25% or something like that. I don't know, I can't remember what it said, but it was significant. But this for me is obviously a buying opportunity, so I'll definitely be doing that. And then the very last one is sentiment. Sentiment is an interesting one because I expected sentiment and gold to do well, but gold is not even doing well in this climate. So when people are generally hedging with gold isn't doing well. So gold mining definitely is not doing well at this current moment. But I'm definitely seeing this as an opportunity to continue to buy into sentiment as well. It's gone down 25% this week. 25% fall in a week is significant. That's a quarter of the business's valuation has gone in a week. If it repeats that in 3 more weeks, there's no business. Like, I think it's generally that serious, unless obviously it gets some form of bailout, probably raises some debt to obviously manage. I don't think obviously it will let it get to that stage, but that's significant. It's just worth obviously being cognizant of that fact. So what am I going to do? April the 6th I can buy more. I'm going to save cash until then, and then I'll just decide. I will decide where to invest and where to deploy my capital at that point. Listen, if you can invest, do so. Not everyone is obviously in the same position that I'm currently in at the moment, where they physically cannot invest because of their ISA allowance restriction. But if you can invest, do so. I'm going to read something from an article that I posted up in the link in when I first started talking about coronavirus and recessions and so forth. And I think this is a really important quote. It's more than a quote. It's a big quote. It's a bit of a paragraph, but I think this is really important. So for those of you that can invest, this is how I generally feel about it as well. People who aim to be financially independent and possibly retire early have one thing in common: they invest. Not only do they invest aggressively, and they do it often. Grant Sabatier, for example, who went from broke to millionaire in under 6 years, checked his progress daily. If he had an extra $60, it went straight to one of his accounts. So we talked about this in a previous video, of investing aggressively, doing it often. Whatever money you have spare, putting it to the market and letting that money work for you. You work for your money, why not let your money work for you once you've obviously earned it? Sabatier and people like him invest a high percentage of their income. Even those who aren't highly compensated tech people shovel in as much as possible. Listen, I get a lot of questions. How do you invest £1,500 a month? What salary are you on? How much money do you earn? What do you do for a living? Blah, 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 blah. Listen, it doesn't even matter what salary I'm on or what you're on or whoever's on. Ultimately, I've always mentioned this: if you reduce your expenses, reduce the amount of costs that go out, all of the things, your cost of living, the stuff that you do to obviously maintain your life as much as possible, and increase your disposable income as much as you possibly can, then you have a lot more money anyway, regardless of what you earn, to be able to do stuff. The challenge with life and the challenge with people is not generally how much they earn, it's actually how much they spend. And actually, because they spend so much that they can't keep track of they're spending, or they've got debt that they're basically paying off, or they spend frivolously in so many areas and they don't cut back on the essential things, or they don't look at ways to actually save on costs. I mentioned to you previously, when I used to rent, I actually went to my landlord, was like, look, I can literally move down the road and save like £200 a month. So what do you want to do? Do you want to lose me, or do you want to, lose potentially 3-4 months worth of revenue whilst you look for another tenant? Or do you want to just reduce your rent? And he's like, all right, cool, I'll reduce the rent. So listen, you can do that. You just have to try and find creative ways to reduce your rent, and potentially have side incomes and side hustles to potentially increase your expenses as well. But listen, it doesn't matter about how much you earn, just retaining as much as you possibly can earn. I can't really stress that enough, and we talked that in many videos. When it comes to the stock market volatility, you're not going to see much nail biting in this crowd. Here's what Jordan Sohanger, a certified financial planner at Girard, an investment manager in Sauderton, Pennsylvania, tells clients when she begins working with them. We say this money will absolutely fluctuate. There are going to be statements you are not happy with. When we're talking about statements here, we're talking about bank statements or investment statements which tell people their return. Typically when people have financial planners, they get periodic statements on a quarterly or monthly basis which tells them their performance. You are not the only one. No one likes seeing they suddenly have less money. Listen, I suddenly have £3,733 less money. So this is something that I definitely resonate with, this current message at the moment. So what does she say? We say this money will absolutely fluctuate. There are going to be statements you're not happy with. Got that? On occasion, you're going to look at your account and feel your stomach drop in tandem with the value of your holdings. You are not the only one. No one likes seeing they suddenly have less money. So Hanger says it's critical to look at what happened in the market to cause a drop. It's critical to look at what happened in the market to cause a drop. What happened in the market? This is what we do every single week. This is the whole purpose of the portfolio update, is to tell you what's happened in the market and to give my perspective on what's caused the drop. There is no point getting into the market, seeing things rise, seeing things fall, seeing stocks rise, seeing stocks fall, and not really understanding why it's risen and why it's fallen. This is the whole purpose of why I do the Saturday show, is to basically try and understand why your money has fallen or why it's risen. If you understand why, then you can take the corrective action. And in some instances, the corrective action is to do nothing and just to sit it out. In other instances, you might obviously have to act on it. But if you don't know why, a 20% drop in a gold stock versus a 20% drop in the airline stock is not the same 20%. There's actually potentially a reason. Maybe the airline industry is down as a whole. Maybe people aren't traveling for whatever reason. Maybe there's an issue with commodities. Whatever it might be, there's always going to be some form of reason. And that's the reason why I try and do this on a weekly basis. So if you are new to the channel, I know this is going to sound extremely boring, but I honestly, genuinely would recommend going through all of the if there's only one series on this channel that you watch, go and watch the portfolio update series from the very beginning, because the whole purpose of this series specifically is to find out what's happened in the market this week, to understand what's gone on with my portfolio, for you to exhibit the same behaviors of what's gone on with your portfolio, so you can plan the corrective action. So you are not the only one. No one likes seeing they suddenly have less money. So Hanger says it's critical to look at what happened in the market to cause a drop. It could be short-term or long-term volatility. Obviously, I personally think the coronavirus is going to be short-term volatility. I don't think it'll be long-term. But if it does trigger a recession, then it might be long-term. So that's my current stance on it. However, as more information I acquire, that stance will inevitably change. But to keep people from losing their mind, she says, help them refocus on their long-term goals. Guys, anyone that's been on this channel for a long time, how many times have I talked about long-term goals? That literally, it's all about goal setting. Once you have a goal and a strategy and a focus time frame, I want to achieve this over this period, you need to stop worrying about the interim fluctuations. Like, I could really start panicking about being £3,733 and 39 pence down, but I'm not going to be panicking about that. I'm just going to sit it out. I know my long-term goals. I know for the fact that with this money that I invest in here, this for me is 5, 10, 15, 20, 25 year portfolio. So if that's the case, I'm not worried about what's happening over 16 months. It's sad to see. Does it hurt? Yes. Would I not like to see it? Of course. But ultimately, ultimately I have to look at this more pragmatically, and this is definitely an opportunity for me in the long term. So that's why I have long-term goals, and this is why it's about long-term investing. And I've had some very, very good discussions in Instagram with some people that, you know, said maybe do this, maybe do that, which I consider is trading behavior, where you're saying, you know, buy this stock, then sell that stock, then 2 weeks later buy that stock, then sell this stock. No one's got time for all of that. Nobody has time for all. I certainly don't have time for all of that. And actually, if I wanted to trade, then I would go to eToro and I would actually just day trade, as you guys know I've done previously. So I'm not using free trade to day trade. I'm not saying you can't. That's completely up to you what you use the platform for. But for me personally, this is about long-term wealth building. And so there has to be a systematic and a strategic element to everything that I do on this portfolio. So you're not the only one. No one likes seeing they suddenly have less money. So Hanger says it's critical to look at what happened in the market to cause a drop. It could be short-term or long-term volatility, but to keep people from losing their mind, she helps them refocus on their long-term goals. She reminds them why they are investing and what their time frame is. How many times do I talk about horizon? Is for meeting those goals. If it's 15 years out, for instance, clients still have plenty of time to recover from a downturn. So if you are thinking long term, you've got plenty of time. Listen, I know some of you guys are thinking shorter term with your free trade portfolio, and that's completely fine. I'm just obviously giving you my perspective, and obviously it's going to vary from person to person. But if you are thinking long term, then, you know, absolutely it shouldn't really be the thing to be worrying about the most. The thing that I wanted to talk about next was actually previous pandemics. So when you look at things like, you know, HIV, AIDS, the pneumonic plague, SARS, avian flu, dengue fever, swine flu, cholera, MERS, Ebola, measles, Zika, all of those different epidemics had different time frames that they were kind of an epidemic for, different time frames that they were a pandemic for, and in terms of the stock market recovered at different rates. Now obviously I historically compared this to SARS, which, you know, 1 month after SARS kind of was resolved, the stock market went up 8.64%. 3 month period, the stock market went up 16.36%, and over a 6 month period, the stock market went up 21.51%. Some analysts now are comparing this to swine flu, where the stock market went up 10% after 1 month, 19.73% after 3 months, but 40% after 6 months after the epidemic was sort of resolved. So the reason why I wanted to basically call that out is, you know, start looking at news headlines for when vaccines are actually found, and when there is a vaccine found, I would start the clock there and actually be like, you know what, maybe this could be the turning of, you know, the dip. Maybe this could be, you know, the thing that actually triggers the stock market to actually go back in the direction that we all love to see it go in. And actually, you know, from a 6 month period from the time that potentially a vaccine is found and people that maybe had a high case of coronavirus have been treated and recovered. I know people have recovered anyway, but those were people generally with obviously a mild case of it, but people that maybe have quite a severe case that have actually recovered very well from it, that might be the time to actually, you know, to consider that the bottom and to start buying. One thing to definitely bear in mind is that while the stock market is going down, it's perfectly fine to keep on buying on the way down, because you know, you never know when the dip is, you never know when the bottom is. Some people ask me this week, when is the bottom, when is the dip? Who knows? I don't know. That's predicting into the future. You can never know when a dip in the stock market is going to be, and anyone that can tell you when a dip is lying to you. So ultimately, you know, continuously buying, continuously dollar cost averaging on the way down and on the way back up again, I think potentially it's going to be a surefire way to potentially get as many shares as you possibly can, and then over the long term, when things do recover and things do take a positive turn, you will start to see some really, really positive gains within your portfolio at that current time, which hopefully, you know, is going to benefit you over the long term. So, you know, in terms of what I think investors should do at the moment, if it was me and I could invest, I would definitely be buying some of the stocks that are down 30%. Personally, for me, I would be doing that. So, you know, I think it's about looking at some of your worst affected stocks, really evaluating whether or not you believe in that business long term, and if you do believe in that business, then obviously investing into that business. I said in my previous portfolio update, I'm going to be investing in cash, and I'm going to do that. I'm definitely going to be stockpiling cash, and maybe even from April the 6th, who knows, the stock market might be 50% down at that point, and people could be saying it's going to go further. I don't know what the future is going to hold, but I definitely know that I'm going to be storing up cash. I think this has taught me a big lesson in terms of having a stronger cash reserves. And don't get me wrong, I follow all of the rules I mentioned. I have my emergency fund. I do have a cash portfolio anyway that's outside the free trade, a cash savings or whatever. And so when I invest, I do invest money that I don't mind potentially losing. That's why I can be positive through these situations, because I have all of the other ducks in a row. I don't have any debt, etc., etc. However, I think I want to build up a bigger cash position so that I can potentially take advantage of this in bigger and greater ways. So that's definitely something I would definitely consider doing. But just more on the soft skills front, you know what, don't panic, hold for the long term, buy what you believe, and ultimately I think you will be fine over the long term. Listen, I know this is probably a long video, but I haven't done any videos this week, so I think it did definitely warrant, you know, a lot of different pieces of information that I could kind of put together. Obviously get in the comments with any questions, thoughts or feelings you've got at this current moment, and I'll definitely respond as quickly as I possibly can to your questions in the comments as well. Other than that, have a great weekend. Don't know if there's going to be any football this weekend. We shall see, but you know what, listen, stay safe out there. You know, forget the stock market for a moment. You guys be safe out there anyway. You know, follow all of the health advice from your local, you know, from you know what's being said on the news, and obviously, you know, any local health guidance as well. And obviously I will catch you this week with a lot more investment videos. Other than that, take care, peace, and I'll catch you next time. Happy investing.